What's going on, guys, and welcome back to my channel. This is Blood Phantom 81, and today I'm going to be talking about my $14,000 M1 Finance portfolio. I've had this portfolio for about a month and a week now. As you guys can see, I started this portfolio around June 6th of this year. However, I've been using M1 Finance for about maybe close to a year now. I've made videos on M1 Finance last year, talking about how much I like the platform. And to be honest, it was never my main source of where I put my money at. And even today, it still isn't. I'm very much a user of Robinhood, and that's where I put most of my money, and that's where I make most of my gains. But to be honest, M1 Finance started out mostly as an experiment because I wanted to see how much I liked long-term investing, dividend growth investing, as well as high-yield dividend reinvestments. And so over the months, however, I've really grown to like the platform, and I've been putting in more money into M1 Finance. I do have a few different accounts, as you guys can see right here. I have another account called Rhino, another account called Narwhal, and the portfolio we'll be talking about here is called Unicorn. I will do an overall review of every single account that I have, but for now we'll just be focusing on this one, which is called Unicorn, which is where I put most of my money in, as you guys can see. And so yeah, let's just jump right into the video. I won't go into the contents of the portfolio just yet. First, I want to talk about my funding. This is pretty much how I start most of my videos regarding M1 Finance. I always talk about my funding schedule. So basically, I deposit money almost every weekday. I'll probably turn this back on. But yeah, essentially, I deposit around $20 every single weekday just to get the best dollar cost averaging in. And something actually pretty interesting happened today, and I would say over the past week. If we take a look at the cash allocation, we know that most of my money came in here around the last week of June. And if we take a look at the last week of June on the S&P 500, which was around, let's say, June 21st, we can see that I missed out on a lot of this dip already. And so I kept on dollar cost averaging in all the way up to the top, as well as all the way to the bottom. And then sometime around August 6th, if we go back to my portfolio, I did do another huge deposit of about $2,000. So I did catch some of that bottom. However, even though the stock market is down today, and if we can take a look at the day that we had, it was actually pretty ugly. Even though the stock market took a really big hit today, and it would be a good bargain hunting day, and like I get paid tomorrow as well, so I can very easily just deposit more money into M1 Finance. I will still do the daily deposits, but the reason why I'm not doing a huge deposit like I did on August 6th is because the fact that we're coming back, getting close to that level, and also getting closer to the 200-day moving average here on the S&P 500 makes me feel like we may not hold it this time. And the other thing is that the level of retracement that we're at from this entire move up from August 6th feels a little bit too deep for my taste. And then lastly, the area that we got rejected at was here at these exponential moving averages. I have the 5 and 13 EMAs here, right here. And if I take out the price action, you can see it a little more clear. This is exactly the area that we got rejected at. And since both of these are sloping downwards, it gives me the impression that, obviously number one, we're in a downtrend. But if we take a look at the, just the daily candlestick, this does feel like we have a lot of potential to just continue bleeding out. If I take a look at TradingView on futures, it's clear that we are getting somewhat of a short-term bounce. As you guys can see, that little green candlestick, that's pretty much all after hours work. However, and I don't want this video to get too technical, but like I said, this is just a bit too deep of a retracement for me, and I can absolutely see us retesting the 200-day moving average and then failing, and then at that point I think it just becomes more bargain hunting. But I'm not going to do another huge deposit until we break this level. That just wouldn't make sense to me. So in summary, I will continue doing my daily deposits, which is my $20 every day, but I won't do another lump sum investment. And that's actually why I made the video today, is because I wanted to get that out there. Alright, so now that we've discussed enough doom and gloom, let's go ahead and talk about the contents of my portfolio. And of course, I'll be sure to leave a description to this pie so you guys can see the contents yourself, and you guys can also see the returns on the contents yourself. All right, cool. So I pretty much have two main slices. One is called dividend growth, and the other one is called monthly high dividend. Monthly high dividend is all stocks that pay at least a 4% dividend yield, and they all pay monthly. If we can see the gain since June 6th, most of my earnings, or pretty much all my earnings, are from dividends. I have $54 in dividends and negative 120 in terms of capital appreciation, but that's pretty close to flat because of how much dividends I've gotten. And we can pretty much see my holdings right here. I have two multi-asset bond funds, which are GOF and PTY. I have a REIT and another financial management company, which is Gladstone Corporation. And both of these pay at least 8% or 7%, I believe. I have SPHD, which is a high dividend yield ETF. This one pays around 4% every single month. And then I have a couple REITs. So I have Realty Income. I have Main Street Capital, and I believe these are also REITs, or that at least they all deal with some kind of real estate or owning properties. Even if like on the label they may not say that they're a REIT, they still own like real estate property for the most part. And so I recently made these a higher percentage of my portfolio. If we can sort by target, you can see that pretty much the top 5 all have 12% allocation. And then I've actually bumped down my multi-asset bond funds down to 10%. They used to be around 14%. But I didn't really like that very much, especially because I'm starting to have more faith in REITs that pay high dividends. I think when they start to compound, they can grow really quickly. And I've actually done some research on that. REITs have, over the past, let's say 10 years, since the '08 recession, and even since the '09 bottom, or even since like the 2011 dip, these REITs in particular have outpaced the S&P 500, and of course that's with total return, especially because of how much dividends they pay. So given all of that, I definitely like these a lot. So I bumped them up a little more. And the other thing I want to show before I move on actually is if we take a look at my pies, we can examine my portfolio a little closer. So within Unicorn, I have two slices. And then I have the monthly high dividend. This is of course from the research tab of M1 Finance. And as you guys can see, over the past 5 years, this monthly high dividend pie that I just talked about would have given me about 24% in terms of capital appreciation over the past 5 years. And then the dividend yield will be a whopping 6.4%, which is close to 6.5%. Expense ratio, not great, but also not terrible either. I mean, that's actually pretty small considering all the funds that I have. So this is about a 0.3% expense ratio. And I keep it very lean, just 9 holdings. This dividend yield used to be closer to about like 7.2% when my multi-asset bond funds were a higher allocation, but I'm totally fine with a modest 6.4% at this point. And I like investing in companies that increase their dividend yields, and that's pretty much what these REITs do. And you're not going to get that with something that pays 9% or 10%. And that's mostly because it's really hard to sustain that. And in fact, if we take a look at my monthly high dividend pie once again, you'll notice that like GOF, for example, hasn't actually gone down in terms of capital appreciation. It's just kind of like a steady eddy, really high dividend payer. So it pays around a 10.6% yield, which is massive. And if you take a look at its performance over the past 5 years, I definitely got in at a pretty nice time. But yeah, for the most part, it's been close to flat, and most of the gains that we get are going to be from that yield. And so I plan on reinvesting all that yield back into my portfolio, especially because, you know, I need all the help I can get, especially when it comes to me reinvesting all my dividends plus all the cash that I have. Those two things combined, you know, instead of a $20 deposit every day, if I'm reinvesting all the dividends I get from these high dividend yield ETFs, it may not be $20 per day on average. It may be closer to like $22 or $23. And so that is actually huge over the long run, especially considering I don't have to monitor this high dividend ETF. So I keep the multi-asset bond funds for that reason. And yeah, I really like the dividend reinvestment power that they give me. All right, next let's move on to my dividend growth pie. And so I would say maybe 90% of these have all increased their dividend yield every single year over the past 25 years. That's also known as being a dividend aristocrat. And so I've talked about this portfolio quite a bit by now. So I'll just go over it pretty briefly. I have a lot of CPG companies. I have a few retail companies within Target and Costco and Walmart and Home Depot. I have some industrial companies, which is 3M, Caterpillar. I think I have Honeywell in here as well. I have just one sin stock, which is Altria, and I have no plans in getting into more sin stocks. I have a couple financial stocks in Bank of America and Wells Fargo. And I have a couple of healthcare related stocks or healthcare slash pharmacy in Walgreens Boots Alliance and also Johnson & Johnson and Pfizer. And one thing I really find interesting is always sorting by my lowest return stocks. And so basically on the top of the list, you'll see the stocks that I have the worst returns on. And so that's going to be Pfizer and AbbVie leading the way. Both of these have taken quite a bit of a hit recently. But of course, the reason why I like sorting by negative returns is because I basically get inspired and I want to average down on these as much as possible. And so this keeps me motivated to keep on depositing money. And honestly, there's very few things that are as satisfying as averaging down on the position that has a really nice yield that you care about and only being after that yield. It really takes out the ego part of dividend investing, and that's probably one of the best things about dividend investing is that when you have a company you trust and you trust will not only hold their dividend yield but actually increase it every year, then you get to focus on what really matters, which is number one, investing your money, and number two, finding deals in the market. So for that reason, I also like dividend yield investing. I also want to take a look at my dividend growth pie just from a long-term perspective. So over the past 5 years, it's given me about 50% in terms of capital appreciation. And that's with a yield of about 3.18%. So if you take the yield and you add it to the capital appreciation and you do an average of compounds annualized returns, then you basically get over a 13% return every single year. And with the dividend yield reinvestment, that probably jumps up to maybe 14, maybe even 15%. I have about 35 holdings. I recently added a company, which was A.O. Smith Corporation. I've made a video about this one recently, which I'll link in the description down below. They're basically an industrial stock, and I deal with commercial gas and electric water heaters. And they're also a dividend aristocrat. And yeah, basically, oh yeah, the last thing I want to say is that I pretty much don't really have favorites in terms of this portfolio. I mean, there are some stocks that I like more than others. Of course, naturally, we're all going to have favorites because we're all humans. But I pretty much keep this in the basket portfolio. And when there's dips in some stocks more than others, then I'm going to want more money to go in those. And so I might bump up the allocation a little bit more if I want, like I said, if I want to focus on them a little more. But it doesn't necessarily mean that I like the ones that are 4% of my portfolio more than the ones that are 2% of my portfolio. It's just about focus at that given time. And that's the other thing I like about dividend yield investing is that I'm not super concerned with, oh, I want to make sure that this one has the right amount of return. And I want to make sure that this one is the biggest allocation in my portfolio. I like them all, to be honest. So yeah, I don't really focus on which one I like more. And with that out of the way, I want to end the video right here. Let me know if you guys have any questions. Let me know what you guys think of my portfolio. I'm curious to hear your thoughts. And yeah, I plan on having this one for a long time to come now. Hope you guys enjoy the video and have a great day.